This week, the Middle East conflict continues to dominate global markets, triggering another sharp move in oil prices, while precious metals come under pressure. Rising energy costs have fueled inflation concerns and pushed back expectations of a Fed rate cut. On the data front, investors will be watching U.S. consumer inflation for February. Naeem Aslam, CIO at Zaye Capital Markets, joins us now for a look into the economic week ahead. Naeem, thank you so much for your time today. You know, the last time we spoke about the tensions in the Middle East, oil was trading around $70 a barrel. 2 weeks later, and man, have things erupted. Just your sense of what is happening in energy markets. We did see oil trading around $120 a barrel earlier today. It has since retraced some of those gains, around $95 a barrel as we speak. But of course, crossing that $100 mark, which has really spooked markets.
Yes, that's correct. Thanks for having me as always. So $100 is the most important line that everyone was really looking for, because remember last week I think we were discussing about oil prices and we said, okay, the reason that we are not seeing too much of a reaction and action in the market because oil prices are very much stable and because the US has access to Venezuela, and that means the US has access to that particular oil. But at the same time, the problem with that is that Venezuela oil is not readily available at the quantity that the world really needs, because obviously in terms of infrastructure and compare that to the OPEC, especially in the Middle East, it's in completely different phases altogether. Now, if you look at the production from Kuwait, you look at the production from the UAE, you see the production from the Saudi Arabia, obviously there is a dramatic fall in that production. And now, even as of today, Iran is saying that if these particular attacks continue on oil fields, which also happen in Iran as well, you could potentially see the prices rising to $200 a barrel, which would be a total disaster for the whole growth and for the whole economy, and moreover, the biggest disaster for the president himself sitting in the office. So I think from where we sit, look, a huge amount of volatility from 120 to back to 95, kind of reassuring that, okay, perhaps those strategic reserves, which many presidents and many governments said that they are not going to tap into, but now they clearly would have to tap into, because those particular supply, which was normal, a new normal would be established. So that means the strategic reserves would come on the market. And the moment that you start tapping into those strategic reserves, you are really sending one message to the market, and that is that panic is actually here, and then now something needs to be done about it. So now the conversations will begin towards OPEC and how OPEC can really increase if this particular dramatic drop will happen in terms of a production. I don't think OPEC can do, because the biggest player in OPEC is really Saudi Arabia, and if there's a damage to the infrastructure, their hands are very much tied by the situation. So it is, when we are talking about situation itself, it's 1/3, and that is not a small number. 1/3 of the US Navy now sits in the Middle East, just surrounding that particular area of Iran. And they are not going to come back tomorrow morning on the flight back to the US. They are there to stay for a much longer period of time. So from where we look at things, we think that this particular situation is going to escalate into a few more weeks. And that is only going to create more confidence shaken down among investors, more uncertainty in the market, and eventually everything is going to boil down to economic growth and the data around which many traders and investors were very confident. They were thinking that at least we have something to fall. Because remember last week, I remember in one of the TV interviews, we were talking about the things now slightly seems like that we are moving away from the war headlines, i.e. it was an Iran war headlines, because markets started to roll back up, though everything was very much in the mid of last year was going back towards the earnings, going back to the United States, going back to the actual macroeconomic factors. But this weekend has shifted all of that.
Yeah, you mentioned some important things there. The conversation around the G7 nations looking to tap into those oil reserves, the strategic reserves, of course. Of course, there is concern around infrastructure over in the Middle East after some of those strikes. And one of the biggest concerns, of course, is also the closure of the Strait of Hormuz. I want to get your assessment on the economic impact, right? There has been concerns around inflation because, of course, higher oil prices would lead to higher fuel prices, and that in turn filtering through to inflation, and that, of course, then filtering through to monetary policy decisions. The Fed, as next meeting is next week. So just your sentiments around that, and whether you have also started pushing back some of your Fed rate cut expectations.
We had about two Federal Reserve rate expectations as of last week. And the main point for us was oil prices, because oil drives everything. It drives your car, it drives your groceries, it drives your everything in your life. And I remember over the weekend looking at a story and speaking to some relatives over in Pakistan as well. Oil prices went up by 50 rupees, the largest increase ever happened in the history. And when we read those particular news, the main thing was that maybe the country is going to run out of oil, and the country is only going to run out of oil because the supply is not coming in. Now, going back to your main question, what you are already referring to, which is a quite interesting one. Look, the person is handpicked by the president, and he is handpicked for one reason and one reason alone, and that is to drive the inflation, but stop looking at inflation, just drive the interest rates lower.
Yeah.
But there's only up to a certain level and extent that the person can really do the job correctly. If inflation continues to remain huge, burdensome, and then it seems like that is the case. So I think the next week's meeting is going to be immensely interesting, because all the journalists, and if I am one of them, I would be asking definitely that what you are going to do about with oil prices and with this escalation in the geopolitics that we are currently seeing. Because as I mentioned, that those troops, they're not coming back home on the next flight. That is not going to happen. Those troops are there to stay for a much longer period. The president has done something, either potentially not thinking fully about it, or perhaps there is something that all of us are missing about this particular puzzle, because this is going to be another long war like Iraq, like what we have seen in the previous episodes of Middle East. These troops are not coming back, and if these troops are not coming back, then that means pressure is going to continue to remain, not to mention the proxy fights, which the White House is very much fueling, and then by putting Iraqi Kurdish in Iran. I mean, like, that is a new guerrilla war that you were talking about. So stability in Iran is completely out of the window. That is not going to happen. And on top of that,
Yeah. Quickly before I let you go, what I've been finding quite interesting, Naeem, is where investors are somewhat hiding their money, right? We do know that safe havens like gold and the PGMs have been in favor for quite some time, but we've been seeing a rotation out of that into the US dollar. What have you been making of that? We've got about a minute to go.
Yeah, I'm not going to mention the most obvious ones. I'm going to give something really unique to your viewers in relation to this one. And that is, look at vessels, look at containers, look at freight companies. Because if we are talking about Strait of Hormuz, then that is where the biggest play is. And then that is where you're going to see the biggest amount of money. If you are looking about the energy market, look at the LNG. The prices have already doubled over in London, because unfortunately UK and Europe is going to have the biggest burn out of this particular situation, because US is very much self-sufficient in terms of oil, in terms of gas. They really don't care. So the bruises are really going to be on the lawmakers based in the UK and in Europe, and the price that will be paid, it will be paid by the public, people like myself and many others.
And it's so interesting that you say that, because Prime Minister Keir Starmer said that the country is in a better position to deal with the energy shock than it was in 2022 when Russia invaded Ukraine. But we'll have to leave it on that note. Naeem, thank you so much for your time.
Thank you.
And sharing
Yes.
your insights with us.
Thank you for having me.
That was Naeem Aslam, CIO at Zaye Capital Markets.